year 2014, you may remember it for the ALS Bucket Challenge, for avocado toast, and also for that Parnell Williams song, Happy. Couldn't get it out of your head. But 2014 is known for something else too, a Guinness World Record for the largest life insurance policy ever sold at the time. A benefit north of $200 million of death benefit. One might wonder, why does somebody need a death benefit of $201 million? I would assume that the family would be pretty well taken care of. Life insurance protects your family, right? And is anybody's life worth that much?
The truth is that the purpose behind such a policy extends far beyond mere wealth preservation or having enough money if somebody passes away suddenly. In this case, the individual likely sought a means to strategically allocate their funds within an IRS-sanctioned vehicle that offers tax-free growth on their investment. The policy wasn't for the beneficiaries. It was for the person buying the insurance. So is permanent insurance for the living, the insured, or the recently passed family members? Well, both. Life insurance may not be the most exciting topic and one that many people don't really want to think about. But if someone depends on you financially, it's a topic that should not be avoided. Life insurance is a way to ensure that your loved ones have financial stability and your income where you're no longer in the picture. It isn't just for the people who die. It can also be for the living. In fact, the New York Times, they describe life insurance as the secret of the affluent. They argue that this approach using life insurance should be accessible to a much wider audience. They feel that the benefits are undeniable. And they're not alone. Many economists agree. So for people seeking life insurance, there are two main types of life insurance: term insurance and permanent insurance. Permanent insurance is a type of life insurance policy that provides coverage for the entire lifetime of the insured individual, as long as premiums are paid and there's cash value in the policy. Unlike term insurance, which provides coverage for a specific period of time, usually between 10 and 30 years, and pays out if you die during that term, permanent life insurance offers lifetime protection and may be an efficient investment vehicle if structured the right way. That's the key part, structured the right way. For this video, we're going to focus on permanent insurance, and after we talk a bit about how life insurance can provide a safety net for you and your loved ones, we'll get into the investment side of permanent insurance. The death benefit paid out by the life insurance policy can help replace lost income, cover living expenses, pay off debts, and provide for future financial need. While permanent life insurance is more expensive and often more complicated than term insurance, you should be aware of all your options. I want to help you understand the pros and the cons so you can decide if permanent life insurance is an option for you to explore. Here are 4 pros of permanent insurance to be followed by 4 cons of permanent insurance.
Lifetime coverage. One of the primary benefits of permanent life insurance is that the policy typically doesn't end, as long as you pay your premiums and there's cash value in the policy the whole time. This means that your loved ones, well, they'll receive a death benefit whenever you pass away. It doesn't matter how old you are, your health status at the time of your death. Permanent life insurance gives you peace of mind because you'll know that your family will be financially protected no matter when you die. Number 2 is cash value accumulation. Cash value lets you access your policy's value while you're still alive. Permanent life insurance policies include a cash value component that accumulates cash over time. What happens is a portion of each premium payment goes towards the cash value, and that money grows tax deferred. The cash value, that can be accessed by the policyholder through what we call a policy loan or a withdrawal. So this ability to build cash value can provide financial flexibility, and often what happens, it serves as a valuable asset in your overall financial portfolio. Number 3 is unlimited deposit amounts without income limitations. As you probably know, there are income limitations as it relates to traditional Roth accounts. Roth accounts are great. They're for Main Street, not Wall Street. They're supposed to be more accessible to the masses, but not if your income is too high. So, for example, in the year 2024, if your modified adjusted gross income is over $240,000, you can't make a Roth contribution. There are also limits for single taxpayers as well. Even if you're eligible to make a contribution, the max contribution you can make in 2024 is just $8,000 if you're 50 and older. Life insurance policies have no such limits. Number 4, tax advantages. This is the big one. Permanent life insurance policies offer several tax advantages. The cash value growth accumulates tax deferred, meaning you don't pay taxes on the earnings until you make withdrawals or surrender the policy. Withdrawals from the policy are categorized as loans, policy loans, and are tax-free.
Additionally, the death benefit is generally paid out income tax free to your beneficiaries. So this provides a tax efficient way to transfer wealth to your heirs. Well, Ed Slott is the go-to resource as it relates to retirement and tax planning strategies. He's the author of many books and articles, and he trains financial industry professionals all over the world. Here's a quote from his book, The New Retirement Savings Time Bomb. The single best, most cost-effective, yet amazingly underutilized strategy for protecting retirement account balances, especially large ones, from being decimated by the highest levels of combined taxation is to buy life insurance to offset the tax burden that beneficiaries may face. Tony Robbins, the author of many books, emphasizes this concept repeatedly in his books and lectures. Removing taxes from the equation can have dramatic effects, and the time required to achieve critical mass and financial independence can be exponentially accelerated. This tax-free growth feature is why affluent people use this vehicle regularly. You may not like paying income tax, but you know who really doesn't like paying income tax? Affluent people. They generally can't contribute to a Roth account because of their earnings, but investing in life insurance bears some resemblance to a gigantic Roth account in terms of how it's taxed. With both a Roth account and life insurance, you pay taxes on your income up front, but once you invest after-tax dollars into a specific type of life insurance policy, the IRS exempts you from paying taxes on its growth and withdrawals. So experts and economists see plenty of upside. But it's not all a bed of roses. There are some downsides. Here are 4 cons of permanent life insurance. The first con of permanent life insurance is cost. According to Forbes, half of Americans said they don't have life insurance because it's too expensive. Permanent insurance is more expensive than term insurance. Permanent life insurance also has higher premiums because it combines insurance and investing. Your money is paying for lifetime coverage and the option to grow cash tax-free. Let's take a look at an example. Say you're 40 and want a policy with a $250,000 death benefit. Looking at data from Forbes, the average annual rate for a 30-year term policy is $365 if you're a male and $299 for a female. A whole life insurance policy, which is a common type of permanent policy, is $35.20 for males and $31.48 for females. The increased expense of permanent life insurance increases the odds that you won't be able to afford your premiums at some point down the line. If that happens, you may have no choice but to drop your coverage, leaving your loved ones vulnerable. That's why these policies must be structured properly. Number 2, limited investment options. While permanent life insurance policies offer a cash value component that accumulates over time, the investment options within the policy can be quite limited. Policyholders typically have little control over how the cash value is invested and may only have access to a predetermined selection of investment vehicles. Also, the growth of cash value can be modest compared to other investment options. In other words, you'd probably make more money in the stock market, but you'd have to live with the risk. This lack of investment flexibility can result in lower returns compared to alternative investment options with potentially higher growth potential. Number 3 is complexity. Permanent life insurance policies can be complex with various features, options, and fees. Understanding the intricacies of permanent life insurance, such as cash value accumulation, policy loans, surrender charges, and dividend options, can be overwhelming. Once purchased, it can be challenging to adjust coverage levels, change premium payment schedules, or switch to a different type of policy without incurring fees or penalties. The last con is that not everyone can qualify. If you're not healthy, you might not qualify because there is an underwriting process and they could deny you. In other cases, you can get the insurance, but the actual cost of the life insurance might be so prohibitive because of your overall health. All policies have costs, and much of that has to do with the cost to insure. If you aren't healthy, this could be a non-starter because the policy, it just wouldn't grow effectively. If that's the case, you're better off without it. Also, if you're older, it may not make sense. Money in these vehicles needs time to grow, so generally age 65 is the upper range where buying a policy makes sense as a tax-efficient vehicle.
There are different types of life insurance policies, but essentially they all pay cash to your loved ones when you die. It's the details and benefits in a policy that you'll have to gain a level of comfort with. Understanding the differences in policies will help you make the best decision about what is the right option for you. Permanent life insurance gives individuals lifelong coverage, cash value over time, and tax benefits. It's important to carefully consider your financial goals and needs before you get close to purchasing a permanent life insurance policy, as they typically have higher premiums compared to term insurance, and your investment options can be limited. They can also be complex, have fees and penalties for certain actions. As always, consider consulting with a financial advisor who can help you assess your options and determine the most suitable type and amount of life insurance coverage for your specific situation. Well, that's all I really have to say about this topic. Subscribe for more informative content on retirement planning, Social Security maximization, investing, and many other financial topics. And as always, thank you for watching.